Bubble Watch digs into trends that may indicate economic and/or housing market troubles ahead. This time, a more philosophical analysis. Bad news: California home prices look bubblish. Good news: values don't have to crash painfully to correct the overpricing. Californians were left with understandable scars after the Great Recession shredded psyches, careers, checkbooks and net worths. But that doesn't mean every time homebuyers get a little nutty, a well-documented California habit, sharp and swift price declines must follow. The past year's surprisingly strong home prices in a pandemic-tattered economy were unnerving. It was a surge propelled primarily by historically low mortgage rates that helped balloon house hunters' urge for larger living spaces due to revamped coronavirus lifestyles. Bubble means the price of an asset has exceeded its underlying value. Nobody has clearly explained to me how housing will remain unscathed after the virus is knocked down and the bargain financing disappears, even if the Federal Reserve gives plenty of warning, as it's promising. Please note, just a 1 percentage point jump in mortgage rates from today's historic lows below 3% would cut a typical house hunter's buying power by roughly 12%. So, I figured a history lesson was in order. I filled my trusty spreadsheet with California home price stats dating to 1975, using a slow-moving Federal Housing Finance Agency index. What I discovered were 3 distinct corrections, defined by me as extended periods between this index's record highs. Yes, it's different this time, can be true. Each one of these painful periods has its own plot, from backstory to duration all the way to the ending. An inflation battle created a short, mild price correction over 2 years. California home prices had surged at a rate of 16% annually for 7 years to record highs in the fall of 1981. These were turbulent times. Global instability and oil shortages created by an Arab embargo of U.S. imports helped flame inflation to 9% that year, making those housing gains, not to mention paychecks, worth much less. Then the Federal Reserve took harsh action to temper inflation, intentionally chilling the economy. Yes, it seems central bankers often have a role in real estate. Interest rates soared and mortgages hit unfathomable heights above 18%. But prices during this correction fell by only 11% to the cycle's bottom, and would hit a new high in the fall of 1983, as rates dropped to, gulp, 13%. Poor economics translated to a housing malaise that lasted much of the decade. When the Fed stopped tethering the 1980s economy, California business and housing boomed, although mortgages never got much below 9%. The housing-friendly savings and loan industry actively lent in a last-ditch attempt to rescue itself. Prices appreciated at a 10% annual rate for 7 years to a record high in the summer of 1990. Then California struggled to shake a minor national recession.